Hi, I'm Pattu from freefincal. Today let's take a look at Nifty Microcap 250 index. This is a new index from the NSE. There is a small confusion with respect to what exactly this index is in terms of index constituents. The NSE says something like it has 250 stocks beyond the Nifty 500. All we know for sure is that this index will not have any stock that the Nifty 500 has. So it has got it takes 250 stocks from beyond the Nifty 500. That's what I originally thought, but there is some small confusion with respect to the index constituents. My original understanding was that if you take the top 1000 stocks by market capitalization at the NSE, I originally thought that this Nifty Microcap 250 index will have the bottom 250 from that top 1000. But Ragesh informed me in Facebook that there is a small confusion in the way that the methodology document is worded. So it can be in the bottom 500. That is, the Nifty Microcap 250 index can have stocks in the bottom 500. The top 500 is the Nifty 500 and the NSE 500. We will generally assume that this will have 250 stocks from the bottom 500. So with that kind of slightly vague definition in place, let's take a look at the evolution of the index. So the index started the trading, that is the trading of the index constituents, actually started only in late May. What I mean by that is the NSE started tracking the index with actual trading, the live tracking of the index only from late May. So most of this data is just back tested data. So there is a big difference between back tested index data and index data when there is actual trading, because once the NSE says that we have now developed an index and these many stocks are part of that index, there can be more interest in that stock. The liquidity of that stock can change, and if the index is if the stock is removed from the index, then the liquidity can decrease, the price fluctuations can happen, and so on. That's why I'm saying that most of this is back tested data. We don't really have much of actual data after the index has been announced. So the black line is the Nifty Microcap index. It's compared with the Nifty 50, which is in red, and the Nifty Next 50, which is in green. All index data are total returns index, which means all dividends are included. I mean, always dividends are included. So you can obviously see that the microcap index has been quite volatile. It zooms up and then it falls down much larger, and then it underperformed during the sideways market before the late 2013 bull market pickup. And then you can see how much it rose up to up to February 2018, and then it practically had a gradual crash, in a huge crash. And you can see the Nifty dropped from here to there, but you can see the actual drop itself for the Nifty Microcap started only here, and so it's had a huge crash, and then it has had a significant big recovery after that. Now, so it's actually obviously much more volatile than the Nifty 50 and the Nifty Next 50, but it does not mean that it is going to, since April 2005, it has not significantly outperformed the Nifty Next 50. You can see that. There's a very strong misconception that goes around saying that if you invest in mid caps or if you invest in small caps over the long run, you will be able to outperform large caps. That is obviously not true. This is because if you track an index, whether it is a small cap index or mid caps, are slightly better. But if you track a small cap index or a micro cap index, you just have all kind of stocks, you know, all kind of good and bad businesses. They're all part of that index, and you have no control over it, and there's really no measured stock selection in the portfolio. They just pick up everything and go. Now this is Nifty Microcap again in black, compared with Nifty Small Cap in pink, Nifty Small Cap 250 in pink, and Nifty Mid Cap 150. Now the Nifty Small Cap 250 is the bottom 250 stocks of the NSE 500, that is the Nifty 500, and the Nifty Mid Cap 150 is the middle 150 stocks of the Nifty 500. So you can see again here that the mid cap has done better, but the small cap, and there is strong similarity in some segments between the Nifty small cap, the pink line, and the micro cap segment. But you can see that even here the micro cap underperformed the small cap index during this sideways moment. That can happen very well now. This is the recovery after 2008, and then this is the sideways market I keep talking about. That could very well be happening now. The recovery has more or less stopped, and then you could be having that kind of a sideways market now. Nobody knows. Now, these are 10-year returns. So each colored line has got 1552 10-year data points. The green is Nifty Next 50, the brown is Nifty Midcap 150, and the yellow is Nifty Microcap 150. You can see that the Nifty Microcap has underperformed for a significant amount of time, both the Midcap and the Nifty Next 50 for most part, except for a small portion here, the yellow line, the Microcap has underperformed. Here I have plotted the Nifty Next 50 in green, Nifty Small Cap in pink, and the Nifty Micro Cap in yellow. And you can see here that the Small Cap 250 has underperformed the Micro Cap. So you can imagine how much the Small Cap has underperformed the Mid Cap also. So that's amusing. And what is probably a revelation to me is that when you compare the standard deviation, that is, this is a measure of the rolling volatility. I am taking a 10-year period, I'm taking monthly returns, and I'm calculating how much the monthly returns are fluctuating and calculating the standard deviation based on that. So higher the line, higher is the volatility. And what is surprising is Nifty Next 50 was the highest up to September, about maybe early 2018 onwards, and after that the volatility of Nifty Next 50 has drastically come down, whereas Nifty Microcap has always been the highest, obviously. And what this means is, if the Nifty Next 50 volatility has come down significantly, this could mean that the returns can go down in the future for Nifty Next 50. I have already talked about it. Even today, Nifty Next 50 is still volatile than Nifty Midcap 150. Over 10 years, it is comparable in volatility to Nifty Small Cap 250 and so on. But going forward, the brilliant returns that we have seen in the Nifty Next 50 may not be reproduced for users. Now, this is a comparison of risk divided by reward. Return divided by risk. So what I've done is I've taken the 10-year return and divided it by the 10-year standard deviation. So it is return divided by risk, or return per unit risk. So in this you can see that Nifty Next 50 has always been higher than Nifty Microcap, which is yellow. Nifty Next 50 is green. So the green line has always been up, which means that for per unit risk you take in the Nifty Next 50 and in the Nifty Microcap, the reward in the Nifty Next 50 has always been higher than in the Nifty Microcap. So there's nothing very sensational about this Nifty Microcap index. I hope nobody comes up with a ETF or a index fund tracking the Nifty Microcap. Already I have shown you how the tracking errors are very huge for mid cap and small cap indices. The tracking errors could be still higher for such as microcap index. Bye bye.